Hello, my friends. Today is May 27th. My name is Joseph, and this is Markets Weekly. Now, this week was super exciting in markets, so we have quite a few things to talk about. First off, we gotta talk about what's happening in the tech sector. It seems like the tech stocks just go up and up and up every single day. What's going on there? The second thing we'll talk about is we'll take a little bit of a detour and we'll talk about what's happening in the Eurozone and in the UK, because markets are connected and what happens there impacts what's happening in the US as well. And lastly, we'll talk about how the market seems to finally be on the same page as the Fed when it comes to pricing in rate hikes this year. Okay, let's start with the tech sector. So let's take a step back and look at the three major market indexes over the past year. Year to date, NASDAQ is up about 25%, S&P is up about 10%, and the Dow Jones Industrial Average is about flat. So tech has been strongly overperforming the other stocks. What seems to be happening is that there's a lot of interest in AI in the tech sector. So as many of you recall, a few months ago, ChatGPT launched, and ChatGPT was thought of by many people as something that's truly revolutionary that will really change the way we do things. And unsurprisingly, many of the largest tech companies are capitalizing on this. So you have Google announcing AI stuff, you have Microsoft announcing AI stuff, and you have Facebook announcing AI stuff. In fact, if you look at a company whose ticker is literally AI, you'll see that that company, even though it doesn't do any cutting edge AI stuff, actually doubled just this month. So there's tremendous amounts of interest in AI, and that seems to be driving tech sector higher. Now, if you're interested in AI, you all need one thing. You need to have good hardware to power all the complicated AI calculations. There's actually basically only one company that designs these cutting edge AI hardware stuff, and that's NVIDIA. So year to date, until their earnings call this past week, NVIDIA had actually doubled year to date. Now it doubled heading into their earnings call. Now their earnings call, as many of you have heard, triggered a huge upward surge in their prices, where after their earnings call, their share price basically went up 25% in a day. Now, NVIDIA is a pretty large company. It's already a several $100 billion in market cap, but it went up 25% in a day like a penny stock. Now, people were very excited what they announced at their earnings call. So from a quarter-over-quarter basis, actually, their sales were down about 10% this past quarter compared to the same quarter last year, but they guided higher for their current quarter. Analysts were expecting that their current quarter would have sales about $7 billion, but they were saying that their current quarter sales look to be about $11 billion, noting that there's tremendous demand for their products due to the excitement in AI. And that basically lit a fire under their stock price and brought the rest of the tech sector higher. And so again, there seems to be a lot of excitement here. Now, this is something that we've seen before, and I'm not talking about in the 2000s when we had a big tech bubble. I'm talking about what happened 2 years ago with crypto. Now, crypto was also a very interesting technology, and it drew a lot of excitement. Companies that had crypto in their description or were telling investors that they were a crypto company saw their stock price go to the moon. And we saw many companies like Coinbase go public to very large valuations. Now, fast forward to today, if you look at all those companies that were involved in crypto, they are not doing as well as they used to. Coinbase, for example, could still be a very interesting company with a very bright future, but their share price is a fraction of it was when they first IPO'd. Now, if you're looking at a stock like NVIDIA that has a really good story because they're powering the future of AI, and you can have to try to figure out just how much, what's the right price for the stock. So this week it went from $300 to $400. And I'm guessing there's going to be people who are willing to buy it at $500, $600, and so forth. If you are a traditional investor, you would look at stock prices from the perspective of something like, price to earnings, price to sales, and so forth. And you wouldn't be investing in the stock. But the truth is, I think that, I'm not sure that perspective has been very useful in investing the past several years, actually. It seems what drives stocks higher is having a good story and stuff like options positioning, where, as we've all seen in the past, if you have a lot of people buying calls in a stock, that can push the stock higher. So I'm getting a sense, just looking at all this excitement in the tech sector, that this is very similar to what we saw during the big frenzy in crypto. And we all know how that ended. And I suspect something like that would happen here as well. Now, I'm not saying that this AI stuff is going to implode or anything, but when you see something go up and up and up and straight up, usually it also can exhibit the same amount of volatility downward. Now, broadly speaking, the economy is slowing, the Fed is hiking, and as we'll talk about later, the market is beginning to understand that. And if you look at the rest of the stocks in the stock market, they're not doing that well. So I think my best judgment is that, this euphoria that we're seeing right now is going to dampen down a lot in the coming months. But I've been wrong before. I certainly didn't expect that the NASDAQ would soar this week, but I would be cautious. So that's how I think about that. Now, going to our next topic, let's talk about what's happening across the pond in the EU and in the UK. Now, those countries are very similar to the US in a lot of ways. There's similar political institutions, similar policy tools, and at the moment, also very similar economic problems. So over the past few years, the Fed has been very concerned about inflation. And indeed, inflation was as high as 9%. Last year, it's now down to about 5%. The same thing happened in the EU and in the UK, but actually to a more significant extent. Right now, inflation is still about 10% year over year in the UK and about 8% year over year in the EU. The causes of inflation there are broadly similar to what they were here. You had, of course, supply constraints, you had labor shortages, and you had sizable fiscal stimulus. A big difference between the US and over there is that is energy and food. So the US is a big producer of energy and food. They export it to the rest of the world and they're self-sufficient. But the Eurozone and the UK import a lot of their energy and a lot of their food. So when you had political disruptions in Eastern Europe, the price of energy went up, the price of food went up, and that fed directly into their inflation numbers. So even though US inflation has come down a lot to 5%, over there it's still stuck at very high levels. The good news is that the expectation is that inflation is going to come down rapidly over the next few months. That makes sense because when we look at things like food prices and oil prices, they were really high last year and over the past several months have gradually come down a lot. So the expectation is that their inflation will drop rapidly, but it doesn't seem like it's going to go back to 2%. Unless, of course, you are a central banker, then you make projections that say something like that. But at the moment, when you look at their inflation numbers, their core inflation numbers look a lot like the core inflation numbers in the US. That is to say, around 4 to 5%. Now, the drivers of high core inflation in the US, so core inflation is just inflation excluding food and energy, is largely wages. So we are service-driven economies, and the largest cost in services is wages. In the US, we have a labor shortage. Wages are going up 5% year over year, and something broadly similar is happening in the EU and the UK. Now, there's this big demographic shift where as our populations age, there are fewer and fewer people entering the workforce. That's playing a role over there as it is over here. I think in addition to that, in the UK at least, they have more people going to school, and so that also takes people out of the labor market. Now, we care about what happens over there is because global markets are interconnected. Now, in response to what those central banks, the Bank of England and the ECB are seeing in the data, they're also talking about holding rates higher for longer. And that's going to feed into the US's financial markets because bond markets are interconnected, and it's going to have currency impacts as well. Now, I suspect that even though the UK and the ECB are going to keep their rates higher for longer, they're probably not going to be able to raise rates as aggressively as the Fed, simply because for them, monetary policy is actually more effective than it is in the US. A lot of their mortgages, for example, are either short term, let's say within 5 years, or floating. So when they hike the rates a little bit, their households immediately feel that, or at least feel that pretty quickly, and so cut back on spending because they have to pay higher mortgage payments, and that'll slow their economy pretty quickly, so they don't actually have to hike rates super aggressively to slow their economies down. Whereas here, well, we have basically everyone refinanced at 3 to 4% mortgages. The Fed can hike to 5%, but that doesn't really impact a lot of households. And I think that's part of the reason why the economy continues to chug along here, even though rates have been so aggressively raised. Okay, the last point we'll talk about today is what's happening with the Fed. Now, over the past few weeks, the Fed has said that they're going to keep rates about 5% or more and keep that for the rest of the year, but the market has been aggressively pricing in rate cuts. If you've been following me, I've been telling you that the market is totally wrong and eventually they're going to have to converge to where the Fed is. And we saw that happen to a big extent today, this past week. So 2 things happened this week that changed the market's mind. First was a speech by voting member Governor Waller, who has been really right on monetary policy over the past couple years. In his speech, he says that for the June meeting, there are 3 options. One is that the Fed pauses and marks the end of the rate hiking cycle. The Fed is just done. It's just going to hold rates here for the rest of the year. The second option is that in June, the Fed actually skips June and hikes July. It skips June. It wants to see more data with the strong hint that it would hike in July. And the third option is to just straight up hike in June. Now, Governor Waller strongly suggested that he is not in the pause camp, that he wants to hike rates, just he doesn't know if it's June or July. And that sends a very strong signal that the Fed actually isn't done with the rate hike cycle. Now, the second piece of news is that we got new inflation data. The Fed's favorite measure of inflation is the PCE index. And the PCE index shows what many have suspected, and that is that the Fed really hasn't done much in its fight against inflation. On a month-over-month basis, core PCE rose 0.4%. Last month, it was 0.3%. It's basically been around this 0.4 to 0.5, sometimes 0.6 over the past several months on a month-over-month basis. On a year-over-year basis, PCE has basically been stuck just below 5% for the past several months as well. So the Fed has hiked rates a lot, and you can either say that, well, it just hasn't taken effect yet, or you can look at this and say that, well, it doesn't seem to be doing anything. So I think the market saw the most recent PCE data, heard commentary from Waller, as well as other Fed speakers, and is beginning to think that, maybe the inflation really is entrenched. Maybe the Fed is not done with its hiking cycle. And we see this coming out in showing up in market pricing like the dollar, where the dollar strengthened meaningfully this past week. And also the 10-year yield went up quite a bit this past week as well. Now, I would expect that to actually filter into other asset prices as well. You can see that excluding the AI-oriented tech stocks, the broader market actually isn't doing all that well. Perhaps as time goes on, as more and more of this pricing seeps into different asset classes, we'll also see it drag down some of the high-flying tech stocks. Okay, so that's all I've prepared for today. Hopefully, if you like what I'm producing, please remember to like and subscribe. And if you're interested in learning more about the markets, check out my free online courses at centralbanking101.com. All right, talk to you guys next week.